Hi, good morning, and welcome back to Kotak Securities Weekly Fundamental Podcast. I am your host, Rini Mehta. Guys, last week was one week to remember, isn't it? As you all know, Russia on Thursday launched an attack on Ukraine via land, air, and sea, prompting fears of a devastating humanitarian crisis and sending shockwaves through financial markets. US and Western allies have condemned Russia's assault, coordinating a squeeze on Moscow by implementing a sanctions package designed to limit international trade with Russia. Now, we will come back to this in a bit. Let's first look at our domestic markets. While the Indian equity markets declined sharply in the past week, both Nifty and Sensex lost around 3.5%. The Nifty was at 16,674 and Sensex was at 55,920. If we look at other indices, the Nifty small cap index underperformed with a loss of around 5.2%, while the mid cap index outperformed with loss of 3%. Sector wise, if we see, all sectors ended in losses on a week on week basis. BSC oil and gas was the biggest loser with loss of around 6.8%, followed by capital goods index. Guys, markets have been sharply volatile lately. Even global equity markets witnessed sharp selling in the aftermath of Russia invading Ukraine. Now, on the economy front, Monetary Policy Committee minutes attributed its status quo on rates and stands to the uneven domestic economic recovery and the need to complement fiscal policy. Now, coming back to the global situation, US President Joe Biden on Thursday said that the US will introduce a new wave of sanctions against Russia in a broad effort to isolate Moscow from the global economy. The president said that the totality of the penalties will target trillions in assets and include specific measures against Russian elites and banks. The White House has also authorized additional troops to be stationed in Germany as NATO allies look to bolster defenses in Europe. European stocks were higher on Friday morning, tracking gains in Asia as market participants assess the impact of Western sanctions against Russia. Europe is also closely watching the fallout from Russia's invasion of Ukraine, with implications reaching far beyond the military and economy. The continent is concerned that a full blown incursion could lead to a major migrant crisis with serious humanitarian, political, and societal costs. Now, with earnings season behind us and given the overall sentiments, markets are expected to move in sync with global peers in the coming week. A close eye will be kept on the developments concerning the Russia Ukraine crisis, and considering the inflation overhang, market participants will also observe movements in energy prices. Amidst all this, if we look at foreign flows, FIIs in the month of Feb were negative to the tune of rupees 37,300 crores. The outflows increased sharply in the last 4 days due to the rising crude prices and geopolitical tensions. So we expect FPI flows to be volatile in the coming months due to rising commodity prices leading to high inflation, monetary tightening, and again the Russia Ukraine crisis. Now, if we look at our top stock picks, our pick of the week is Mphasis with ad rating and target of rupees 3,650. Mphasis reported healthy organic growth of 5.7% quarter on quarter in constant currency terms, underpinned by strong 7.7% organic growth in direct business. Strong growth in direct business can sustain given strength in BFSI, expanding addressable market, wallet share gains, strong mining in top accounts, and quality new logos. Margins face multiple headwinds but can return to a 15.5 to 17% band. The recent correction makes the stock attractive. So we retain ad rating and fair value has been increased to rupees 3650 from 3500 earlier on rollover, valuing the stock at 32 times FY24 EPS. Moving on to the next stock, you can also consider buying Cummins with a target of rupees 1160. It has been an interesting journey for Cummins from a flattish EPS over financial year 13 to 20. to 20% EPS CAGR over the past 2 years of COVID 19. KI's EPS estimates have been broadly flat over the past year and now look less of an outlier versus the street. We still note a disconnect with parts of the street that view Cummins' power gen business as having limited terminal value. We expect Cummins to drive and benefit from transition away from diesel. Interestingly, in KIE 2022 conference also, management reiterated them being beneficiary of energy transition. The management reiterated key tenets of our thesis on why Cummins is a fuel agnostic play on energy transition and why it would actually benefit from such a move. One is diesel for now will continue given a lack of a substitute high on power density and reliability. Second is Cummins would leverage shift to natural gas given its strong product offering and high price point. And third is hydrogen would be the way forward for India where Cummins is well placed. As per Cummins, battery based storage solution may not be a good alternative for a country like India, lacking in lithium deposits and with China dominating the refining capacity for the metal. India may want to avoid such energy dependence, especially after seeing limited leverage of energy dependent European Union to influence energy rich Russia's action during the Russia Ukraine crisis. So, guys, with this, we come to the end of the podcast. See you next week with more insights. If you like our podcast or have any feedback, do share with us in the comment section below. Thank you.